Okay, a very good evening to everybody. My name is Samuel, and I will be speaking to you all tonight on the coronavirus and its impact on US indices. Before I begin, everybody able to hear me loud and clear? Maybe just put it in the chat box and you can see it before we actually start the webinar in proper. Okay, all good? All right, thanks for responding. All right, so before we begin, just a little bit about this webinar. This webinar will be on the coronavirus and its impact on US indices. So for this webinar itself, we will actually be focusing on futures products. So for those who are not very familiar, maybe this will be a good time to learn about it, as well as how you can use it to do day-to-day trading or hedging against the markets, with markets so volatile right now. So without further ado, my name is Samuel, and I'll be starting this webinar in proper. So a little disclaimer first. Everything said here will solely be for education purpose and does not constitute to any form of financial advice. A little bit about myself. I'm an investment analyst at Phillip Futures. I specialize in the equities, indices, and forex markets. On the day-to-day, I do provide daily commentaries to our clients, as well as you may have seen me on various media sources before. So for today's webinar, is actually quite interactive. It will go on the fact that right now everybody is also worried about COVID-19 and the fact that it has impacted markets quite wildly. You can see that right now 5% movements intraday has become the norm, and it's very hard to even predict what is going to happen next because of all the situations that are ongoing, and of which we can see that it has impacted market a lot. Swayed market confidence quite a bit, and we can see that markets have actually moved from the bull market to right now into bearish territory. So we will go into this in this order for the webinar. First, we'll start off with US equity indices futures, explain what is it, the overview thus far, as well as our forecast for the next quarter. Lastly, we will share about how to partake in the market action using futures itself. So we all know that there are actually 4 major US indices: the Dow, the S&P, the Russell, and the NASDAQ. However, what many people may not be very familiar is what's the difference between all of them, right? So to begin with, the Dow, which is now most commonly quoted on the news media itself, is that the Dow actually tracks the largest 30 component stocks in the US, and it's actually quite evenly weighted. You see it more focused on the industries as well as financials, etc. So right now, when you are looking at what is happening in the COVID-19 situation, you can see that the Dow is actually more impacted than others. Why? Because it's very focused on the industrials, consumer services, and financials, and of which we can see that these are the sectors that are impacted by COVID-19 itself. And so that's why we can see that the movement in the Dow recently has been more drastic. So you can see this is the top 30 component stocks. You can see that Boeing plays quite a huge component of it, and all of this actually right now with COVID-19, you can see that Boeing is impacted. All right, for the S&P itself is the 500 more commonly bigger names in the US itself, and the industries wise are more diverse also. So you can see that it has quite some component on technology, healthcare, financials, industrials, etc. Similar to Dow, but in terms of company wise, there are much more companies in the S&P itself, and if you're looking at it, there's less industrial components in it. So if we look at the bigger names, it's more of Apple, Microsoft, Amazon, etc., the tech names. And you can see that in terms of percentage wise, the individual component percentage is much lesser than Dow. It's more diversified. All right, how about for the Russell? The Russell is for people who are actually looking at small cap stocks, because itself it comprises of 2,000 companies in the small cap sector. So if you're looking at momentum in terms of volatility, it may be greater than the other indices, US indices itself. So if you can see, it's similar to the S&P, quite well diversified. However, what happens is that it's more weighted on the small and mid cap stocks, not so much of the bigger household names. So if we look at it, you can see that each component has a very small weightage, and it's more of the unknown names, which you may not see it on a day-to-day basis. But if you are more adventurous, would like to deal more of the small and mid cap, the Russel may be something you can consider. And the last one will be the Nasdaq. Nasdaq, I'm sure a lot of you all have heard of it. Tank stocks, etc. All this belongs to the Nasdaq itself. So your technology names, the more household brand names as well. So we can see that a large component of it is actually based on technology, 61.26%, and of which we can see the major FANG stocks, the Apple, Amazon, Microsoft, Facebook, etc. So it really depends on which particular index you are more keen on in terms of sectorial exposure. So the main difference is this between the four indices is as followed. The first thing is that the S&P is made out of 500 large cap companies, and it's more sensitive to tax cut and energy deregulation, etc., because of the fact that it's more well diversified. For the Dow Jones, main thing is heavy on the industrial and financials. So in terms of infrastructure spending, or right now even COVID, etc., it's more sustainable to that. For the Nasdaq is very heavy on the infotech stocks, and then you can see that it's with regards to immigration control, protectionism. Last year itself, if you're looking at the Sino-US trade war, and then after that you can see that in terms of any technology advancement, etc., it's going to affect the Nasdaq in greater context. Lastly, for the Russell, it consists of 2,000 small cap stocks, and it's deemed to be the most volatile US index among the four. All right, so it's more sensitive to tax cuts, small business initiatives, etc. All right. So then we'll be looking at what are the key drivers that affect US indices. Actually, we're looking at it, right? These key drivers affect a lot of different indices as well, not only just US. So the first thing we are looking at is actually interest rates. We must understand that there are two broad classes of assets people usually invest in. One is the equity side of things, the indices, and two is the bond side of things. So definitely when we are looking at it, when interest rates are low, people will want something which gives them better risk to reward ratio, and they will look at something like stocks, etc., or indices, higher risk products, because by putting their money in the bank, etc., they may not gain that much return, or bonds will give them lower yield. And if, like example, interest rates are high, then we can see that things like putting savings, putting money in banks or bonds will have higher interest or higher market interest per se. And so right now, with the Fed constantly lowering interest rates, which we saw recently, it actually, in theory wise, should be better for stocks itself. However, because given the time and sensitivity of things that you see at the moment right now, you can see that the stock market didn't, or the indices itself did not really benefit from the surprise rate cuts the Fed had. Okay, then the next will be about monetary policies. With monetary policies in place to sustain the economy, usually more beneficial for equity, for indices itself as well. So you can see that if fiscal policies or monetary policies are put in to sustain the economy, you can see that it can actually support various indices itself. Economic data is important as well, because what happens is that it shows how well the country is faring, or the country's economy is in the global aspect. So if, like example, the country is able to sustain its economic growth, lower its unemployment rate, etc., this will be beneficial for the index as well. Political events are something that is very crucial because it actually shows the stability of the country. If, like example, the country has constant political events like you see last year, whereby Brexit was in full bloom, etc., it will not usually reflect very greatly on the country's index. And lastly is the global environment. The global environment will state the risk level of investors. It will give you a gauge of it. So, like example, if people are right now with the COVID situation in place, people will be more fearful. All right, they may want to hold cash instead because they will not know what's going to happen next. All right, so with that, it actually gives you a glimpse into the investor's mentality. So the key drivers that affect US indices, all right, we actually bring them down. It's actually quite data driven, all right. So in terms of data driven, we do categorize them into three main categories: labor, inflation, and economy. And if labor, we are looking at unemployment rates, etc. All right, inflation, we are looking at how the inflation rate is like and whether the cost of living, etc., is still affordable. And lastly, the economy, whereby we're looking at their GDP numbers, their PMI numbers, etc. So now now that we have actually touched the brief of it on how we actually analyze markets, right? We are going in depth on how the US markets are actually faring. So how do you think markets are right now? Okay, so we all know that this year is the year of the rat in the Chinese zodiac, and because of that, the rats are usually linked to things like diseases. And this year itself, we saw the emergence of COVID-19 itself, whereby it started to struck the global economy. So we feel it's a battle between the bulls, the bears, as well as the virus. So we get to see who emerges on top. And so right now, you can see that with the virus in full bloom, the bulls and the bears are all very afraid, and you can see a constant struggle between both sides. And so this year itself, you can see markets being relatively volatile. So right now, markets, in our opinion, is the bull running away from the bears, right? And you can see that it's both sides still fighting and very, very volatile. So if you're looking at the E-mini Dow futures, right, you can see that since the start of the year, till when this chart was obtained a few days back, it fell approximately 35%. Okay, and the surprising thing is that the intraday movement has actually increased drastically since COVID-19 actually came into play and the situation worsened as it stretched away from China. So you can see that because of that, the increased volatility actually caused more movement in the market itself. Right, you can see similar things happen to the S&P as well, whereby the S&P fell approximately 30%. Sorry, we will be pausing for a while due to the audio situation. Just give me a minute. Hi, sorry for the technical difficulties. Are you all able to hear me better right now? All right, please leave your comments in the chat box. Then after we can carry on from there. Are you all able to hear me? Is it clearer? All right, can you hear? Is it clearer? Clearer? All right, so let's begin. Okay, so like just stating just now also, so you can see that for the S&P itself, it's quite similar to the main overall US index, whereby you can see it fall around 30%. So for the Nasdaq slightly a bit better because I think the main thing is technology side is more sustainable in the sense that whereby even with COVID itself, people are still using technology in their daily life and in fact using it more intensively to replace physical contact. And because of that, you can see that the technology names did not fall as much as the others, and it's still sustainable. It fell relatively lesser at 22%. However, if we look at the Russel itself, because it's more volatile and the names it's the smaller cap stocks as well, you can see that the fall is even greater and it fell approximately 41.79%. So because of all that in mind, you can see that actually markets are actually falling in great demand, right? Since the start of since the peak since the widespreadness of COVID-19 actually took place. So if we look at the performance of global index futures, whereby we are comparing the US indices versus the other index, we can see that actually the NASDAQ itself did quite well. It paled in comparison to the others. The China index itself as well, you can see that China and NASDAQ itself, the A50 as well as the NASDAQ, did better. They fell around close to 20%, whereas the others fell around 30+%. So why the China index or even the Hang Seng and did better than most other US indices is because of the fact that they saw the virus peak in their various nations in the early stage of things, whereby that happened in end January and start of February, whereby you can see that at the point of time, US indices were still soaring. But right now, what happens is that as the epicenter shift from Asia to the West, and right now we can see that more nations in Europe and UK and US itself are impacted by COVID-19. That is when you can see that the sell-off to those indices are greater as well. And this has resulted in those indices falling in greater depth these 2 days. So, as we all said, New Year, something new will happen, but for 2020, New Year, new market movers. We can see that last year itself, back in 2019, what dominated markets or what dominated headlines essentially were the Sino-US trade war, as well as the Fed in terms of Fed not lowering interest rate that much. However, once we hit into 2020, we can see that the headlines totally shifted. The resolving of the Sino-US trade tensions, whereby both signed a Phase One trade deal, eventually just evaporated in thin air, whereby people were expecting economy to do better this year, actually suddenly vanished overnight because of the emergence of COVID-19 itself. We can also see that the economic reality is fighting due to COVID-19 and a sudden emergence in terms of the OPEC. Right now, Saudi as well as Russia itself, they are having an oil spat. Okay, so with all of this in mind, it actually caused huge volatility in markets this year. All right. So the emergence of COVID-19 first made headlines in mid-January itself. For those who may not be that aware, where Wuhan was the epicenter of the whole virus. Okay, so go on.
Hi, everybody can hear me? Is it loud and clear right now? Is the audio better? Sorry for the inconvenience caused. All right. Okay, let's carry on. So, like stated just now, in case you may not be aware that actually the COVID-19 itself made headlines back in mid-January, whereby Wuhan was the epicenter. So we can see that even though the first few cases of COVID-19 was actually back in end 2019 and start of 2020, it actually started being on the headlines in mid-January itself, all right, whereby they start whereby the cases of COVID-19 actually spreaded in China itself, and Wuhan suddenly had a lockdown. All right. So by the end of January, there were already growing numbers of cases outside China, and the Hubei province, whereby Wuhan is part of, was actually put in entirely into lockdown, and the WHO have actually declared COVID-19 as a global public health emergency. So this escalated further, in fact, and by early February, alarm bells start to ring as the death tolls from COVID-19 actually surpassed that of SARS itself. And we can see that people getting COVID-19 was actually more common as well, due to the fact the infectiousness level of this COVID-19 is actually greater than that of SARS. So in mid-February itself, more hotspots appeared outside China with spikes in cases in South Korea, Iran, and Italy. And in fact, they were deemed as a clear signal because of the fact that the virus was widely spreading out of China itself. And this actually sparked panic. So we can see that even in stock markets itself, in the indices, it was actually reflected in mid-February, whereby people start seeing more volatility itself. So you can see that March actually sparked the start of the COVID-19 being declared as a global pandemic and the worldwide spread of COVID-19. So by March itself, we see that Europe appears as the new epicenter, and right now, at mid-March, we can see that US, UK are all, there's widespread in those countries as well, and many countries have actually announced global lockdowns. Okay. So what is the impact of COVID-19? I think if we look at the images in the slide itself, it paints 1,000 words. How often do you see the Singapore landscape with nobody or no tourists in sight? Or you can see hot tourist attraction spots like even New York with hardly anybody on the streets. When that happens, it actually shows something is really going very wrong with the economy, or what's happening globally itself, because nobody dares to travel. Right now, many countries are having nation lockdowns, and we can see that there are very little people on the streets, little tourists, lesser spendings, and you can see that people are not traveling itself. So the service industry is badly impacted by this. We can also see that because of this nation shutdowns, many supply chains have been broken. So like it started off with China, whereby China had factory shutdowns, all right? And then even with China's factories barely yet to fully recover, all right, we can see that right now there are shutdowns in various countries, like in Italy, in the EU side of things, Germany, France, even in the US as well. So all of this actually caused companies not being able to deliver on their promised product launches, etc., and it has resulted in demand and supply shocks. Why demand and supply shocks? Is because there will be lesser demand because these factories are in shutdown, and the supply is because of the factory being shut down, other supplies are being impacted as well. So this has actually resulted in snowballing of issues in the global economy, and this resulted in a lot of panic. All right, so there were also a lot of cancellation of events, and I think events are something that people have to be very wary of. Why is that so? Is because events actually is one of the main revenue for a lot of companies, because it's actually where deal making takes place. So you can see even back in February at the Singapore Air Show, there were much lesser exhibitors, and because of that, deal making actually dipped, with a lot of exhibitions, even the tech exhibitions across the globe being cancelled. It presents lesser chance for people to network and lesser chances for business deals to be forged, and this will actually impact the global economy as well. So because of all of this, you can see that there has been a widespread corporate earnings downgrade across the board, all right, and this has actually caused markets to fear of a possible global recession or even a depression. And this is why markets are facing huge sell-off, or in fact, markets itself, you are seeing that there is a lot of volatility. So we can see that since COVID-19 actually happened, various countries are facing manufacturing numbers having downgrades, etc. And you can see that the numbers are downbeat itself. All right, so we can see that China is the one that shows the earliest signs of numbers being affected because COVID-19 started from China. All right, I mean, as in when it started spreading itself, it started spreading from China. So what happens is that China was the first economy to actually have the shutdown. All right, so you can see that this is reflected in its January numbers and February numbers as well. And from there, you can see that there was a drastic dip in terms of manufacturing. All right, because there were lesser orders. All right, there was lesser demand, etc. And because of the lockdown, they could not even manufacture their products. So as we move to March, we can see that in February itself, some nations have started being impacted as well, like the EU, etc. So all of this has resulted in their numbers falling as well. And right now in March, with things sort of like rapidly developing in EU and the US itself, we can see that going forth, these numbers may be more impacted, and this will actually cause more jitters in market itself. So we can also see that sporting events like Olympics, it was officially postponed. All right, we can see that there has been economic downgrade across the board as well, and then there's an economic collapse in the EU because business activity dipped drastically. In terms of airlines wise, airline companies are being affected because there was a mass shutdown of flights, a lot of grounding of airplanes itself, and then we can see that a lot of countries have barred citizens from traveling out or foreigners from entering their countries itself. So because of that, you can see that the tourism and the airline industries have been badly impacted by the whole thing. So with that, the economy reality is actually biting. It has actually caused the recession possibility to increase. All right. So if we look at the Fed, the New York Fed recession probability based on the Treasury spread, we can see that by Feb 2021, which is next year itself, the probability of entering recession has spiked to 30.7%. All right, this is actually quite high because if you notice, every time this spikes up, it's followed by an economic crisis. Like back in 2008, whereby this spiked up itself, we can see that there was the Lehman Brothers crisis. So right now, people are already viewing this as a huge crisis itself, and you can see that the probability of US recession, the numbers have been spiking up. So we can see that it has also been predicted by other Fed members as well. All right, Fed member Willard recently actually had an interview whereby he said that he painted a more drastic picture than what was forecasted. He stated that U.S. unemployment rate may hit 30% in the second quarter this year, and he also foresee an unprecedented 50% drop in U.S. GDP, and this is well warranted. Why is that so? Is because what happens is that people are predicting that the effects of COVID-19 may last longer than initially expected. Because right now the widespread and everything is still slowly a development that is still slowly developing. All right, we can see that if some nations have lockdowns for 2 weeks to a month, whereas some nations like the Australia have announced lockdown for close to 6 months. So because of all of that, we actually note that people are still very uncertain how long this will last, and if the longer COVID-19 actually lasts, there will be greater impact to the economy, and even with the measures in place, it may not be able to fully cushion the whole situation, and this has resulted in market sentiments being more fearful. And by fearful, we notice this. What we noticed this time around is that the fear seems to be broad-based. All right, so we can see that there was a mass liquidation across all asset classes. Traditional safe haven assets such as bonds and gold also face selling pressure, and we can see that it actually makes it known that people actually are rushing for cash. And why people rush for cash is because they felt cash is king, and they are worried about their future cash flow or their ability to make payments for their existing debts, etc. So that's why we note that business has actually begun to hoard cash in fear of the future cash flows as the upcoming revenue becomes largely unpredictable due to the current situation, because nobody, not even disease experts, are able to predict how long the whole thing will last, as more and more people get COVID-19, and till date it's still not known whether numbers have peaked, and people are unwilling to commit on that as well, because the numbers in terms of infection rates are rising rapidly, and the infection rate appears to be even greater than SARS. Also, we note that the risk of loan defaults have risen because of right now the economic situation. A lot of people are more fearful, and then of that you can see that some companies, in terms of forecasting and everything, people have predicted that some companies may default on their loans, etc., because of their cash flow being hindered. Right now, it's slightly different from SARS, because what happens is that in SARS itself, we did not see huge lockdowns of nations, but right now what happens is that we can see that various nations have actually closed their borders. Economy-wise, in terms of a lot of shops, they are forced to be locked down. Lockdown means they can't open, means they don't even have business. However, in terms of salary-wise, in terms of sunk costs, it's still there, and because of that, we have to note that this actually increased the loan risk, etc., and people are more fearful for that. So, if we can see across the board, all asset class have been dropping. So we can see that the US bond yield has also dropped. All right, they dropped around 44%. You can see across the board, the S&P dropped around 30%, and gold itself dropping around 5%, around 6% as well, from the start of February itself. All right. So because of that, if you put that into play, we note that actually COVID-19 really caused markets to actually sell off across all asset class, even though some asset class may not face that much that great of a sell-off as compared to others. But because we notice the shift of fund flow, whereby people are changing between asset class, as some asset class may be looking more attractive, it actually resulted the whole shift in terms of the whole sell-off in markets in general across all asset classes. So, aside from COVID-19, there was another unforeseen circumstances that happened in February itself, all right, which is the Russia-Saudi oil spat. So this actually started in the OPEC meeting at the start of the month, all right, whereby there was a disagreement in it, and then after then Saudi started declaring a price war on Russia itself. So this actually added fuel into the fire, all right. It caused the crash in oil prices due to the increase in supply, all right, and lower demand because of COVID-19 actually added to market woes. You can see that it actually steepened the sell-off as a whole, because right now people are of the view that oil itself, they are facing strong selling pressure. All asset classes are facing strong selling pressure. They do not know where the market direction is going to be. So Saudi appears determined to keep oil prices low. Recently there were some announcements, etc., and of which if we look at the prices, they are trying to press prices lower, and they are also unlikely to meet each other halfway, because you can see that the tensions are still high between both nations, and the next meeting will actually be in June. If both nations are not going to compromise everything, it may result in more sort of like negativity towards oil itself. So we also see that the US have hinted on possible intervention, and if the US intervenes, it may most likely not be a good thing, and it may actually spark more chaos to the already very complicated situation. So because of that, what we feel markets are going forth, as right now we can see that a lot of negativity is still in markets. We feel that the bulls may be scared, more volatility may be ahead, and the bears are sort of like a nightmare to everybody. So even though we can see that markets having a slight recovery yesterday and today, we can see that today itself there was a continued upside momentum in US futures. Last night was the best night since 1933 for the Dow futures itself, whereby it rose drastically. Because even though with all this positive news, we feel that we are actually not out of the woods yet for US indices, because it's still a very tough time ahead, whereby people are trying to fight with COVID, and itself there's still a tough struggle between the pandemic-induced economic downside against the policy stimulus that the government have put in place itself. We also see that COVID-19 is a biological situation, and that medical breakthrough appears to be the only solution to resolve it per se. Cash shortage will still bring towards a potential downside risk for US indices. So right now we can see that the two opposing forces are very strong, and volatility is very huge. We can see that today itself, the 2 million coronavirus stimulus plan was approved. All right, the US and the White House as well as the Senate actually came together and forged and managed to strike a deal. So the expected components of the plan will include the individual cash payments, loans to businesses, funds for small businesses, healthcare relief, airport relief, airline relief, as well as strengthened unemployment insurance. So all of these are actually very beneficial to the economy as a whole. However, we must note that right now it's still not affirmed in terms of the eventual bill, and it has not been implemented yet. Why? It's because even though it has passed through the Senate, the House need to approve it as well before it's signed by President Trump. So the timeliness of this bill is still very important, because only if it's quickly implemented will it have the most impact, and it can really aid with the US economy. We can also see that other support measures given includes the interest rates being slashed close to zero. The Fed has actually a lot of measures in place as well, including including QE itself, and including unlimited loans to actually support businesses. So because of that, these are actually all very strong stimulus measures, and it's actually aimed to soften the economic impact towards the US economy itself. Also, you can see that President Trump is actually very business-centric. He's actually aiming to open large sections of the country by Easter, which is 12th April. So all of this are actually showing that there are actually two sides of the camp. One side of the camp in the US is actually very pro-business. They're actually wanting to the economy to recover back in the US, but there are of course another side of the camp that is more health conscious itself. So we can see that for those who are more health conscious, it actually things like we will see negative impacts to the economy, whereby you can see things like lockdowns, etc. So all of these are actually detrimental to the US economy, but it may be necessary to actually curb the virus. So what happens is that right now in the New York State itself, it has the third largest amount of COVID-19 cases, just behind China and Italy. So New York is actually appearing as the new epicenter of the COVID-19 virus itself, because right now just one state, the number of cases has actually surpassed countries like even France, South Korea, etc. Just last night alone, they actually increased the number of cases by over 10,000. So all of this are actually showing that the situation in terms of the COVID situation in US may not be that optimistic as expected, and because of that, there may be more downside risk through the US itself. There are also many lockdowns across various states. Okay, so we can see, like as explained just now, whereby if you look at the numbers, when China had a lockdown, their numbers were affected greatly. So right now, with US states entering lockdowns, their numbers will be impacted as well. The key gauges of US manufacturing and services have also fallen the most on record. If we are looking at last night's numbers, which I will show you all later, and we can also see that unemployment numbers have been creeping up. All right, so all of this, the uncertainties with regards to how long this will last, as well as how much impact is going to affect the US economy, and whether the stimulus will be enough for the US economy will strongly weigh on people's minds. And because of that, we can see that there is a struggling of two opposing forces to see who is gaining control in terms of people thinking that there's more downside risk and some people thinking that the worst is over. So because of that, you can see that there's a constant struggle, and right now there is still strong volatility in markets. Also, the US has a strong potential to become the new COVID-19 epicenter based on the number of cases it has. So if we look at the US PMI numbers released last night, we can see that manufacturing numbers have dipped into contraction territory already, okay? And the service numbers, because of COVID-19 itself, lack of tourism, etc., you can see that the service numbers have fallen to a low of around 39.1, which is also in contraction levels and very worrying. We can see that the initial job claims numbers have been spiking up as well. Of late, if you look at the last 2 weeks numbers, it has been increasing, and many times if we look that when the initial job claims numbers spike, is usually they are having a recession. So if you can see the red bars down there, they do indicate the recession in the US itself. So with numbers spiking, people are worried that we may enter a recession again. So we can see that volatility is back on Wall Street itself. Right now, volatility is more than 4%. All right. Our intraday movement, sometimes we can see a lot of limit ups and limit downs for the past 2 weeks. Limit ups will mean 5% difference and limit downs as well. So we can see that the intraday volatility is still very high. So with that, actually people are very panicky. They do not know where the market direction will be. So we can see that the 5-day intraday movements is now the new norm. If we look in the past movements are between 1 to 2%. Right now, easily doubled to tripled. Sometimes it can go as much as 6 to 7%. So we can see that right now, with strong volatility, people are still unsure whether the market has bottomed or whether it's time to enter the market even, because the huge swings have actually dampened market confidence greatly. So just to elaborate a little bit more, volatility is good for people who actually would like to trade futures because you can partake in the intraday movement. But that being said, because it's still too volatile, we cannot call a bottom yet. The only time whereby people will call bottom or actually sees market strength returning is when the volatility dies off. Because at that point of time, people will be more confident that they can see a market direction, whether is it bullish or bearish, and they will naturally come back into the markets. Because with too much volatility, what happens is that whichever direction you are going, some people, once they call the wrong direction, they may be impacted in one way or another, and that's why it has caused more fear. So it depends on what kind of investors you are. If you are the more risk-loving investors, current markets will be good for you. But for those who are more conservative, then you may want, some of them may be more fearful. And only when the volatility dies off, that people will start entering markets, and we can call that market strength have started returning kind of thing, and we can call for a clear direction of things. So right now, we also know that COVID-19 is actually a biological situation. It's unlike the previous situation we have seen, which can be easily resolved by monetary or official policies. Like example last year, whereby we have the Sino-US trade war and everything. It can be resolved once a trade deal is fostered kind of thing. But this time around, we noticed that the only way for this biological situation to be resolved is a vaccine or medicine be invented, and with the medical success, then we can address the root of the problem and solve the situation. So right now, we notice that the economic downside attributed is more of an effect and not a cause. So what happens is that the measures implemented are also addressing the impact. The impact of the virus caused the economic downside, and people are addressing the impact. But only when the cause is resolved, and that will this economic downside risk be eliminated, and then we can see that markets will start to recover from there. So if there's a medical breakthrough in terms of new vaccine or new medication, this will totally eliminate the risk, and from there we can see that markets start to recover. So right now, the situation have actually far exceeded that of SARS in terms of widespreadness as well as severity. because in the SARS period, like explained just now, we did not see any lockdowns, we did not see any forced ban of travels, etc., whereby people stay at home, countries having lockdowns, etc. We must understand that by spending, or in terms of economic spending, will the nation actually have economic power and boom? So with now all the lockdowns happening, the economic impact is drastic, and this is not seen since at least for the past 50 to 60 years, and people are describing this to be as bad as the past depression we see in the 1940s, etc. All right, so they are actually comparing this instead of to SARS, more of to World War II, whereby we see a lot of disruptions. So in terms of Olympics, this was a good gauge, because what happens is that the only time they actually postponed Olympics the last time was due to war, and right now is because of COVID-19. They had to postpone Olympics by 1 year. So this shows that people are viewing this very severely, and the only way to resolve it is really to come out with a cure to COVID-19 itself. So containment efforts thus far has also not seen much success. We can see that actually, if you look at it, it has been quite of a failure, whereby countries did not manage to control inflows into it. There were some countries that were complacent, and because of that, what happens is that the cases spike quite drastically. So without proper containment efforts, right now we can see that it has come to a stage whereby nations have to lock down to actually control the spread and cure the existing people and prevent them from actually traveling or spreading to other people. Because what happens is that for COVID-19 itself, the incubation period is between 2 to 3 weeks, and people cannot detect the symptoms fast enough, and that's why containment efforts is very crucial, and people and nations have to lock down right now. So at the start of COVID-19, people are predicting a V-shaped recovery, because they feel that once this impact is gone, markets will recover immediately. However, we have the view that it's still unlikely at present, because this may last for a more prolonged time than initially expected. And after the whole virus situation wears off, there may still be some time required for economies to gain back momentum, and that's why we still view that a U-shaped recovery is still possible. But that being said, there are still many unpredictable factors, including the development, and it still has to be closely watched. So the last thing is actually cash shortage. So cash shortage is a very strong point. Why is that so? It's because right now, with all the assets being sold, what happens is that people are actually finding solace in cash, and cash has become king. So what happens is that we notice that the US dollar funding squeeze is still far from over, despite the recent Fed's unlimited QE measures to ease the liquidity of US dollar. So you can see that the US dollar has been strengthening rapidly. Why is that so? Is because it has forced the demand of cash, and people need US dollars to repay loans, because US dollar is the world reserve currency, and a lot of the loans are actually in US dollars itself. So that's why financial liquidity becomes very important, because if once the liquidity dries up, it will cause various issues, especially if the dollar strengthens too fast, because it's intertwined with various systems itself, and there can be a domino effect where the repercussions are grave. So what happens is that because once default happens, or companies are not able to pay their loans, etc., and there's no other ways to do so, it will cause a domino effect when one company falls, and then it causes many to follow suit. And this could result in the 2008 financial crisis once again. Because if we look at the 2008 financial crisis, if we look what exactly triggered this, is because of cash shortage, whereby there was insufficient cash by the banks, etc., and because of that, various companies started to collapse, and this resulted in a domino effect. So if this happens, even though now measures are in place already, but there's still a possibility, and if this happens, it may cause a greater widespread of loan defaults, as well as greater downside risk. So if we look at the forecast itself, we note that right now we are still on a downtrend. So we have recently found some support at the previous lows level in terms of 2018 levels. So right now we can see whether it's going to rebound. But however, like stated just now, for a true recovery, we still need volatility to sort of like subside first. If not, it's still very difficult. And we can note the same applies for the Dow Jones futures as well. We see some support at 127 levels and then some slight rebound. So we still have to observe a little bit more before we can call it a complete recovery. So for the second quarter 2020 outlook, we still feel that actually COVID-19 will remain and that it's still too early to call bottom until the volatility cease. All right. So the economic impact will last beyond the second quarter, and people are predicting it may even go into the third quarter. So the COVID-19 developments still remain key. Hopefully, containment efforts will be effective, and once COVID-19 is controlled and travel bans are lifted, etc., it may actually give a better outlook to the global economy itself. So the best solution will still be a medical breakthrough, because with the development of vaccines as well as cures, this will definitely nip the issue in the bud. But what happens is that we do note that clinical trials need some time. So there are few clinical trials ongoing already. So we have to see the results based on those after that. All right, the cash shortage could aggravate the situation further. So this will be a key thing to note. Even though we have liquidity measures in place by the Fed, etc., we still have to observe the cash situation to see how it unfolds. Although the COVID-19 has taken over as the key theme this year, we also have to note that other factors such as the Sino-US trade relations and the US presidential elections will remain on the backdrop, and this may actually be brought into picture soon as well once the COVID-19 situation shows some stabilization. So with that, I mean, as in with markets so volatile, what we feel is that even though there is still a lot of upside, people are also worried whether there's equally that much of a downside, because markets are still very volatile. So with that, maybe futures can be something you use to hedge against your positions, or to use to speculate on the market movement as well. So to make market information work for you, there are various instruments that you can use. For indices, usually people would use futures products itself. So what are futures? Futures is essentially a contract agreement to buy or sell a certain commodity or index at a price agreed today for delivery date in the future. So because of that, you are locking in the price, and then after that, you are able to speculate on the movement itself. So for hedgers, it is good because, like example, if you have a stock, all right, you can use the futures to protect yourself against the downside risk. And if you are a speculator, you can use this for independent trading and to speculate on the market action itself. So there are various types of futures contracts: stocks, metal, energy, commodities, currencies, etc. And today we are covering on the stock side. So that's why if you are interested, the stock indices futures will actually be of interest to you. So why do we trade in futures? The main thing is these three points, which is you can short sell. So if you are thinking that the markets are going to go down further, you can short sell first, or you can long the product if you're thinking it's going up. It's simple because you do not have to do individual stock analysis. You can just monitor the main macro movement and partake in the market action based on that. Also, you can be either a hedger or a speculator. It works both sides. So it's bi-directional as spoken. You can go long and go short. So you can profit from both a rising and falling market environment. So like example over here, whereby if you have unexpected results announced leading to market fear, so you can just short the market because you won't know which stock will drop more or which stock will drop less. So you can just short the index as a whole, and you can benefit from it. It's also simple because instead of doing a company analysis, you just have to do the main broad scope of the index itself and save a lot of time doing the analysis. So if that's the case, it's very hard for you to call which stock to pick, and using the index may be even easier. So you can also do hedging or speculating, all right, as spoken just now. So like example, if you have shares for Amazon at a point of time, if you want to hedge, you can just sort of like short the futures, and eventually once this wear off, you can close the position and you can earn from the futures even though you lose on the stock itself, because sometimes if you sell the stock, if you do not know when to re-enter, you may miss the opportunity from that. So by just directly hedging a stock portfolio with futures, it acts as a form of insurance. So for futures contracts itself, they are derivatives, all right, they are derived from the underlying assets. For like example, the indices itself, while they do not last forever and have expiry date, you can always roll over the contracts to actually prolong your positions. They are also leveraged, so only a fraction of the amount is needed, and so because of that, you can stretch your dollar. It will amplify both your profit and loss, right? And lastly, it allows bi-directional trading, so you can long and short the markets for both bullish and bearish views. So with that, we'll end our presentation, and if there are any questions, please feel free to put in the chat box and I'll answer them accordingly. Yeah. Okay, so I'll read out the questions if any, then after that, then I'll answer it from there. Okay, so the first one, if I hold a view that the index will go up, say maybe 1 year or so, but volatile in between, what is the best product for me to trade? CFD, futures, or other products? All right, so to answer your question, if you want it, if it's volatile, actually what happens is that you should use futures as a hedge to hedge on this volatile period, because what happens is that for futures itself, even though there's an expiry date, etc., it is exchange traded. So meaning to say you can see the prices and the momentum as well is quite regulated. So it acts as an alternative for you to actually partake in the market action in terms of the volatility. If what you can do is that if you think it's a direct uptrend, then definitely some people may want diversification in other asset class and not just futures alone. But if you think it's going to be volatile, then naturally, if you are just letting your money, you are just putting in an asset class for a long-term play, then you may be missing out on the opportunities. But of course, this will be dependent on your risk level. And if you are able to sustain the risk level for futures trading, I would say that just go ahead and make use of this market opportunity to get some exposure in it. And if you have underlying assets, like example stocks, etc., which may be losing money from the downturn, you can actually hedge your portfolio as well. So it works both ways. For as in for other products, it really depends on what exact cost you are looking for at the end of the day. If you are looking for speculation, which we should have said because of the volatility in between, I think that futures may be one of the products you would like to consider. So the second question is, how effective can unlimited QE sustain if COVID-19 caused continuous lockdown for 3 months or more in the US? I would say that the unlimited QE can sustain for quite a while because of the fact that you must understand that the US has been through the 2008 financial crisis where it rapidly prints money. With now the demand for US dollars, because it is the world reserve currency, unlimited QE will still help, and because of that, it can still sustain the economy. That being said, the US can go into lockdown for 2 or 3 months. It will have economic repercussions. It's not just the US alone, but the entire globe. And that is the reason why President Trump is looking at restarting some parts of the US as well. Because what happens is that you must understand the US is as big as China in terms of the economy wise. And when we see that what happened when China shut down for a few weeks, the economic impact was drastic, especially to the Asia side. So with US, another market leader, if they have sustained lockdown as well, it's not going to be beneficial for the globe. And that's why what happens is that people are trying to negate this impact and hopefully cushion the overall blow. And that's why it's with the QE unlimited QE in place, it actually will help to sustain the whole thing. And hopefully with the lockdown in place and whatnot, still the markets will not suddenly just crash. Will the rally this today last? Time to go long for the long term now. That's the third question. Like stated, what we are seeing right now is we are not calling the bottom yet, because it's still too early to call the bottom as all the risk factors are still there. But that being said, a lot of things have been factored into markets already, because markets is always you must note that markets are always very forward looking and they are efficient in a way. That means they will price in all the news that has been on the markets. So like example, the impacts of COVID-19, the lockdowns in the various states, they have already been priced in. So unless we see things that are worse than expected, it will cause even greater downside. But if there are nothing worse, the downside may be not free, it won't be a free fall drop, and that there may be still some support here and there. All right, for right now, I would say that to call for recovery, what people will be looking at will be at least 2 consecutive days of positive gains. And if you look at the futures market itself for the US side, the US futures have yet to close, and we cannot say that tonight definitely it will be still a gain. So because of that, I think one of the earlier signs will be 2 consecutive days of gains, and subsequently from there we get to see whether it's sustainable and the volatility tones down, because only with a thinning volatility will market strength actually return. So for the fourth one, what is your strategy suggestion for Dow futures now for intraday? How to get the good entry for long or short? Any signal we could try to monitor? I would say that this is a lot about entry levels and exit levels, about technical analysis. So I mean, you definitely will have your own indicators for that. People will use different signs in terms of the moving averages, RSI, stochastics, etc. There are too many different indicators to use. I would say use the one that you're most confident in, and from there structure a strategy to enter and exit, because there is no absolute right or wrong strategy for this. Yeah. Midterm impact of the stimulus plan to the market for the fifth question. I would say that the midterm impact itself, we will be looking at definitely huge government spendings, and this will impact the overall country's GDP, because of the fact that you will have by spending this amount of money you will have less revenue, or the fact that the country will have less revenue, or the country will have lesser funds to do other things like buildings, etc., kind of thing, because the budget is that much, and by allocating more to a relief package, etc., they will have lesser budget to do other things. But that being said, this is definitely necessary, because it needs to sustain the economic growth to the financial markets itself. And if we do not sustain the economy, the impact may be much greater as well. And because if we are looking at fiscal policies usually have multiplier effects, and this will actually help the economy in the long run as well, because we need a greater factor to offset the downside risk itself. So the midterm impact of the stimulus plan, I would say it will still be beneficial for the country itself. And the main thing is we need to remove the cause, because by just trying to suppress the effects, it may not be sufficient. It's just like when, example, if you have certain sickness, if you do not treat the sickness and constantly take Panadol to suppress the pain, it's not going to resolve the issue in the long run as well. So this is the same thing for the economic measures that we are seeing right now. All right. So the duration of possible recession, I would say that this is very much dependent on how long the COVID-19 virus will last as well. And right now, with the numbers still very preliminary, it's very hard to state, because of the fact that there's still too little data to come out with something conclusive yet. Things or data to look out for to buy the dip. That's the next question. I would say that I mean, it will be dependent on your view in the long run, whether you are seeing that it's going to be a recovery or a continual drop. If you think that there's going to be a recovery, so what are the things to look to buy the dip is, I would say, lesser volatility, all right? Once the volatility dies down slightly, and then you can see that the number of cases peak, or the fact that there is virus, there's a sort of like, I would say, a breakthrough in the cure to sustain the virus, then all of this will actually be signs that people look at to buy the dips itself. Of course, if you are looking at short-term trading, people use technical analysis to see technical patterns to buy the dips as well. The quickest sectors to recover, I would say the first thing will be the banking side per se, because of the fact that once people see a recovery and everything, they will have to take loans, etc., to actually sustain the business, and this may actually give more support to the banks. The ones that may see later recovery will be your travel related industries. All right. So should I take a longer expiry of futures instead of rolling many times? What do I miss holding this view? All right. So just to explain, if you take a longer expiry of futures, the longer dated futures may not be priced that competitive in terms of the current market price, because you are paying the premium for the time. Also, liquidity may not be there. So when people are actually speculating in futures, they usually will put into consideration the fact it's for more short to mid term, and of which maybe it's not that suitable to buy a long-term dated futures itself, because we won't know what will happen in the meanwhile. And if, like example, there's lesser liquidity, you may not be able to exit should you want to at any point of time as well. All right. So the next question, if I see recovery in 2 years' time for the SPX, which is the S&P, which month of futures contract should I trade in? Active month, then roll over every month, or just select April 2020 or 2022? I would say that you should roll over every quarter. All right. So what happens is that if you are looking at CME futures, they are dated quarterly, so you can just roll over every quarter, because of the fact that in terms of liquidity, etc. If you are buying a too long dated futures, what will happen is that there may be very little liquidity, and this will be quite detrimental to your trading activities as well. Russel is the least impacted in this. Any opportunities from them? All right. So that's the next question. So I would say for Russel, I wouldn't say that they are the least impacted from this. Many countries are actually under declaring their numbers, or they may not be doing active testing. That's why you are seeing it as like, oh, the virus may not be that prevalent in that country, or that their control is good, or that their economy may not be that badly impacted. But that being said, we must understand that the WHO has declared this as a worldwide pandemic, and it's actually spreading across various countries, okay, due to right now travel has become so rampant. So because of that in mind, we have to take note that it may still develop sooner or later. All right. For Russia wise, one thing to note is that they are still impacted by the oil crisis as well, due to the oil spat between Russia and Saudi. So this would weigh on the economy as well. I mean, as in, if you like opportunities in them, definitely there would be some people who would still see opportunities in every index, but it will be dependent on you to see what you're comfortable with in the long run. All right, the next question is, where can I learn more about futures trading? So if you are interested, I mean, this is across various countries, correct? So because of that, you can always find your regional Phillip office to talk to. All right, after this webinar, we will also send you a thank you email with the link to today's video, as well as the how to contact us, and you can always drop us a call to find out more, or in fact arrange to meet up with us. All right. So for the last question, after unlimited QE announced, is it a good sign for gold? Any forecast for gold in the near term and long term impacts? All right, so if we are looking at the gold prices, we can see that last night itself, gold prices actually rebounded. The main thing right now is because of the fact that there is a lack of supply, and that's why the prices are going higher. It's because of the increase in demand, because people are looking at safe haven assets at the moment, and because of that, the lack of supply, the decoupling between the US side as well as the cash market side resulted in gold prices actually increasing in terms of prices as well. So I would say the unlimited QE definitely will be better for gold as well, because with QE in place, naturally the dollar the QE is aimed to weaken the dollar. So with that in mind, people may go towards other safe haven assets like gold as well. So gold still does have upside potential, and people may look at gold as well. Gold do have futures, which we do offer as well. So with that, we will end the presentation. Thank you for your attendance tonight. Anything, please feel free to contact us or reply to our thank you email accordingly. Thank you.